You ever see a trading strategy that's posting some absolutely massive return and you think to yourself, is that for real? Is it too good to be true? Well, today we're going to pull back the curtain and go way past those flashy profit numbers to get the real story. We're going to explore 4 key metrics that show you what's truly going on under the hood. Okay, before we jump in, the usual but very important reminder. This is all for educational purposes. It is definitely not financial advice. Every single trade and investment carries risk, so you've always got to do your own research. All right, let's get right into it. You know, one of the biggest traps I see traders fall into is judging a strategy just by its final return. And why is that a trap? Because that one little number can be incredibly misleading, and I'm about to show you exactly how. So let me just ask you this. Is a 200% return automatically a sign of a fantastic strategy? I mean, you'd think so, right? But the truth is, it's not that simple. It really, really depends on how you got there. Okay, so check this out. We've got 2 strategies. Both of them get you to the exact same place, a sweet 200% gain. But strategy A, that's the smooth, predictable climb. Strategy B, well, that's a chaotic, heart-stopping, wild ride. The final number is identical, but the journey, and this is the important part, the risk, is totally different. Seriously, which ride would you rather be on? So how in the world do we tell the difference between a smooth climb and a wild ride when the final number is the same? Well, that's where our performance dashboard comes in. Today, we're zeroing in on these 4 heavy hitters, the Sharpe ratio, the Sortino ratio, maximum drawdown, and the Calmar or MAR ratio. These are the tools that give you the complete picture. All right, first up, let's talk about efficiency. This is all about answering one simple question for your strategy. How good are you at making money for the amount of risk you're taking on? And our number 1 tool for this is the granddaddy of them all, the Sharpe ratio. It's pretty much the industry standard. Basically, it looks at the return you're making above a super safe investment. And then it divides that by your strategy's total volatility. You know, how much your account balance is swinging up and down. A higher Sharpe ratio is a great sign. It means you're getting more return for all the turbulence you have to sit through. Honestly, the best way I've found to think about the Sharpe ratio is like this. It's your strategy's miles per gallon. It tells you how much profit mileage you're getting for every unit of risk fuel you're burning. You want a fuel-efficient strategy, right? More bang for your buck. But here's a thought. Is all volatility actually bad? And that's where things get really interesting with our next metric, the Sortino ratio. This one is a super clever upgrade because it only punishes a strategy for the bad volatility, you know, the drops that actually lose you money. Remember that wild ride we talked about? The one with those huge swings? Well, a lot of that volatility might have been massive jumps up. Is that a bad thing? No way. We love that. The Sortino ratio gets this. It completely ignores those awesome upward swings and only cares about the scary, gut-wrenching downhill parts of the ride. So let's put them side by side. What's the real difference? Think of the Sharpe ratio like a strict judge. It dings you for every single bump in the road, up or down. But the Sortino ratio is a smarter judge. It lets the exciting upward jumps slide and focuses only on what actually hurts, the downside drops. This makes it a way better tool for strategies that can have those big positive spikes. Okay, we've talked about how efficiently you make money, but now we need to talk about the other side of the coin, which is just as, if not more important, measuring the pain. This is all about facing the reality of potential losses and just how deep they can go. And the absolute star of this section is the maximum drawdown, or MDD. This metric answers what might be the single scariest question for any trader. What is the most money I could have possibly lost with this thing? It literally finds the biggest single drop your account took from a high point to a low point. This number, this is your worst case scenario. And the analogy for this one? It's perfect. Your max drawdown is the single deepest, most jarring pothole you hit on your entire journey. It's the number that puts a value on that horrible feeling in your stomach when your account is just falling. A lower MDD means a much, much smoother ride. So this is where it all comes together. What if we could take our returns and our pain metric and mash them into one super useful number? Well, that is exactly what the Calmar and MAR ratios do. They take your average annual return and divide it directly by your maximum drawdown. It's reward versus worst case risk, all in one number. Think of it this way. The Calmar ratio tells you how fast your strategy can climb back out of that deepest pothole we just talked about. It's all about your strategy's resilience, its bounce back ability. A higher Calmar means you're just generating more return for every unit of that drawdown risk. It's a fantastic way to measure recovery power. All right, now that you know the tools, let's talk about how not to use them. Because just looking at one of these numbers in a vacuum, that's a recipe for disaster. So here are the big mistakes you gotta avoid. First off, please, don't just chase a high Sharpe score. A strategy can have a beautiful Sharpe and a drawdown that is so terrifying you'd never be able to sleep. Second, make sure your data actually means something. These ratios are pretty useless if you only calculate them on like 5 trades. And finally, never forget the golden rule. A truly great strategy has to pass the return test, that's our Sharpe and Sortino, and the pain test, like max drawdown and Calmar, both. Okay, enough theory. Let's make this super practical. I'm going to give you a quick 1-minute drill you can run on literally any strategy you're looking at. Ready? Here's your 5-step checkup. Step 1, just get your basic data together. Returns, volatility, the essentials. Step 2, calculate your efficiency. What are those Sharpe and Sortino ratios looking like? Step 3, measure the pain. Go find that maximum drawdown. Step 4, gauge your recovery power with the Calmar or MAR ratio. And finally, step 5, you put it all together. The winning strategies are the ones with those high efficiency and recovery ratios, but, and this is key, a low maximum drawdown. It's all about the balance. Look, if you forget everything else from this, please just remember this one thing. The best strategies are not the ones with the highest returns. They're the ones that find the perfect balance between making a profit and managing the pain. So I'll leave you with this question. Now that you've got the tools, go take a hard look at your own strategy. Run the numbers. What score does it get when you actually look beyond that final return number? Hey, thanks so much for sticking with me on this deep dive. And just one last time, remember, these tools are for your educational toolkit. Always do your own thorough research before putting any real capital on the line.